Over the weekend, the United States carried out a military strike in Venezuela and captured the country's president and his wife. The entire operation reportedly took place within just 30 minutes, which is incredible. But that's not what I want to focus on. Instead, I want to focus on what this means for the world, the markets, and most importantly, for you as an investor. I don't want to waste any of your time, so let's jump right in. Now, while the US initially framed the attacks as an anti-drug operation, after the operation, Trump began talking about how the US would run the country for now, rebuild oil infrastructure, and take out tremendous amounts of wealth out of the ground to sell to global customers. So, as it turns out, the real reason is oil. Venezuela currently holds roughly 300 billion barrels of oil reserves, which is the largest in the world. At current oil prices of around $57 per barrel, that would put the value of those reserves at about $17.3 trillion. To put that into perspective, this is more than the total GDP of every country in the world, except the United States and China. It is also roughly 4 times the size of Japan's economy. However, this does not mean that the US can immediately turn those reserves into real supply. That's because Venezuela's oil industry has been severely damaged over the decades. So what happened was that after the industry was nationalized in the 2000s, foreign oil companies gradually pulled out and investment dried up. Many experienced engineers left, routine maintenance was neglected, and infrastructure began to deteriorate. And later, sanctions also made things worse by cutting off access to financing, equipment, and spare parts. As a result, oil output in Venezuela has fallen by roughly 70% from its peak, dropping from over 3 million barrels per day to under 1 million barrels per day today. According to some estimates, restoring production in Venezuela would require tens of billions of dollars and many years of sustained investment. And even then, this is under the most optimistic assumptions. In fact, we have seen many similar situations before, where things went very wrong after US invasions. For example, after the US invasion of Iraq and the removal of Saddam Hussein in 2003, what followed was years of insurgency, civil conflicts, and political uncertainty. In the end, it took nearly 20 years of stabilization, repeated waves of foreign investment, and massive infrastructure rebuilding before oil production meaningfully recovered. Another example is Libya. After NATO and US intervention in 2011, Muammar Gaddafi fell, and the country was left without a unified military or a broadly accepted political center. In the end, Libya fractured into rival militias and competing governments, and more than a decade later, the country is still suffering from instability today. Then there's Afghanistan. When the previous regime was removed and a new system was installed, it never gained real legitimacy. It depended heavily on foreign support rather than public trust. Once that support faded, the system collapsed and the Taliban returned almost immediately. And in Venezuela's case, even though the US has removed the president, much of the underlying power structure still remains. The vice president is still in place, key military and security figures are still there, and the Cuban intelligence presence that supported the regime has not disappeared either. That is why there are still serious questions about whether the regime itself is truly gone, or whether this is simply a change at the top without real structural change underneath. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. But beyond oil and Venezuela, this event has a much bigger implication for the world order. What this episode really shows is how major powers are willing to act when strategic interests are at stake. The US did not wait for broad international consensus or approval. Instead, it chose to act first, then dealt with the diplomatic fallout later. For China, this is especially significant. China buys more than 80% of Venezuela's crude exports. Besides that, China is also a major investor in Venezuela's mining and infrastructure under Xi's signature Belt and Road Initiative. Oil shipments from Venezuela to China were not just a trade, but a mechanism to repay debt and cement long-term strategic influence in the Western Hemisphere. And over the past 2 decades, China has extended up to $60 billion in loans to Venezuela, with much of it tied directly to oil-backed repayment structures. However, now with the US intervention and the capture of Maduro, a large portion of that financial and strategic exposure is now at risk. What makes this even more interesting is the timing. Just hours before the operation, a Chinese delegation was in Caracas meeting with Maduro. While this may be coincidental, this shows that the US is reasserting its dominance in the Western Hemisphere and making it clear that there is limited space for other powers to expand their influence there. Now, some commentators argue that this could embolden other major powers to act more aggressively in their own regions. For example, Taiwan's reunification with China. However, most analysts believe that an immediate military move by China is unlikely. The reason is that China is widely seen as playing a long game. Chinese policymakers believe that long-term international trends still favor their goals of national reunification and broader national rejuvenation. Now, let's talk about what this means for the markets, starting with oil. After the operation, oil price movements have mostly been muted, and the reason is simple. While Venezuela holds massive reserves of oil, its current production is already very low by global standards. In fact, Venezuela now produces less oil than many much smaller producers and contributes under 1% of global supply. The longer-term implications, however, are much more interesting. If the US successfully stabilizes Venezuela and brings production back over time, that will add supply to the global oil market. More supply generally puts downward pressure on oil prices. Then there's also an important currency angle. In recent years, Venezuelan oil exports have increasingly moved away from the US dollar towards the China yuan. This fed into the broader idea of a petro yuan. However, if Venezuelan oil production eventually comes back under US influence and is sold primarily in US dollars again, that will reinforce the petrodollar system. If this is successful, it could mirror the 1970s US dollar petrodollar deal, where Venezuelan oil is priced back into US dollar, which could flood demand for US dollars again, while recycling petrodollars into US treasuries and giving the greenback a massive new lifeline against de-dollarization threats. However, with that being said, this is not something that happens quickly. Rebuilding Venezuela's oil industry could take years and require billions of dollars in investment, functional institutions, and political stability. Now, what about gold? Historically, gold tends to perform well during periods of elevated geopolitical tension, especially during times like right now. And sure enough, after the attack, gold prices moved about 2% higher. Beyond short-term fear, there's also a longer-term structural driver supporting gold, which is central bank demand. Over the past few years, central banks around the world have been steadily increasing their gold reserves. The key reason for doing so is diversification. Many countries want to reduce their reliance on the US dollar and US treasuries, especially after events like the freezing of Russia's foreign reserves in 2022, which show that dollar assets can be weaponized during geopolitical conflicts. Given this setup, JP Morgan is predicting that gold prices could reach $5,055 by the fourth quarter of 2026 and potentially rise even further to around $5,400 in 2027. From today's price levels of around $4,410, that would imply an upside of roughly 15% to 22% over the next 1 to 2 years. But what about the stock markets? The operation in Venezuela was quite similar to what happened in Panama. In 1989, the US invaded Panama to remove its leader. While the invasion took a little over a month to complete, it was also fast, direct, and very similar to what we just saw last week. At the time, the US stock market did react negatively, but only briefly. During the first week of the invasion, the S&P 500 did fall by about 2% before quickly recovering shortly after. So based on that, I would also expect the markets to behave in a similar way this time. Now, while it is true that the S&P 500 eventually fell close to 20% in 1990, that decline had far more to do with the 1990 recession, rising oil prices triggered by the Gulf War, and tighter financial conditions rather than the Panama invasion itself. But looking ahead to 2026, the bigger factor for stock markets is likely to be the midterm elections. Historically, midterm election years tend to deliver lower average returns as compared to non-election years. During midterm election years, from January to October, markets tend to struggle with policy uncertainty, before rallying later in October once the uncertainty begins to fade away. However, there's one important difference this time. Trump is currently serving his second term, and historically, midterm years during a president's second term have tended to be much stronger. In the past, markets delivered positive returns 100% of the time in the year following the midterm, with average gains close to 20%. Notably, the largest maximum drawdown during these periods was only around 5.8%. Will it happen again this time? I guess time will only tell. So, how should you invest during a time like this? To be honest, nothing much has changed. Despite wars, geopolitical shocks, recessions, and so-called black swan events, markets have tended to move higher over the long term. The Venezuela situation, as dramatic as it feels right now, does not fundamentally change their pattern. Because of that, reacting emotionally is usually the biggest mistake investors make. Panic selling, going all into cash, or trying to chase so-called war stocks or short-term headlines can often lead to poor timing and long-term regrets. What has worked more consistently is far less exciting. Staying diversified across regions and asset classes, sticking to a plan that was built for both good times and bad, and continuing to invest regularly even when the news feels uncomfortable. You do not need to predict the next geopolitical flashpoint to build wealth. You just need a process that can survive them. And in moments like this, doing nothing is often the most disciplined decision that you can make. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.